Money. Money.
As I said in the beginning of the show, for all my regular listeners as well, you know my full-time job is a mortgage professional. That's what I do day in and day out, so I thought I'd bid. And new lending regulations through the CFPB as part of the Dodd-Frank Act. Congress established the Consumer Financial Protection Bureau, CFPB, through the Dodd-Frank Wall Street reform in direct response to the 2008 financial crisis. Under CFPB, the Consumer Protection Act was established. Changes to how we could lend money. Now, the CFPB website defines it as the ability to repay rule in intent to prevent consumers from getting trapped in mortgages that they cannot afford, and to prevent lenders from making loans that consumers do not have the ability to pay back. It's simple. There have been a lot of changes since Congress established the Consumer Finance Protection Bureau through the Dodd-Frank Wall Street reform. How mortgages professionals are compensated, that came first. How appraisals are ordered came in next. Documentation that's requested, that's actually been through the entire process. And now we have TRID. TRID is the Truth in Lending Act, RESPA, Real Estate Settlement Procedure Act, Integrated Disclosure Rule. So TRID, really what it is, it's a disclosure rule. One disclosure with loan estimate, or what they're calling the LE, that replaces the GFE, good faith estimate, and the initial TIL lending disclosure. And then you have the closing disclosure of the CD, which replaces the final truth in lending disclosure and the HUD-1 settlement statement. TRID rule was originally to go into effect on August 1st, but extended it to October 3rd, which we are now dealing with TRID. Really easy with TRID. It's to make it easier for consumers to understand what type of mortgage that they're getting. So again, it's a disclosure rule. Now, additionally, it holds lenders accountable for disclosure on all the fees and potential fees so that the consumer doesn't receive any surprises charges at closing. So good news. The new disclosures were created after an extensive consumer industry research and analysts with public outreach and feedback. 850 consumers were interviewed in the process of developing the forms to ensure their clarity and ease of the use of the forms were accomplished. Much different when they changed the good faith estimate the last time. When they updated the good faith estimate, they did not talk consumers on how easy it was to read them, because it was actually harder than the old one. So I have to say, as a mortgage professional myself, these disclosures are a good thing, and they are very, very easy in comparison to what we had before for the consumers. Now, CFPB tested using the LE. 9% of consumers tested could identify their loan amount, compared to 61% of those using the existing forms. That's huge. Consumers tested, 90% could say when the interest rate could change, and when using the LE, up from 81% of people using the existing forms. Huge change. When asked whether settlement charges have changed from the LE to the corresponding CD, far more people accurately noted changes with the new forms versus the old forms. So basically the initial disclosures that are going out versus the ending disclosures. Can you see the difference between the two? Before, they were two completely different disclosures. You had the good faith estimate, and then you had the HUD-1 settlement statement. Didn't look like anything in comparison. So now they're identical forms the way they read, and being able to make the differences between the two will be easy for the consumer. Making it easier for clients to understand is good for everyone. The issue is additional timing requirements. So that's where the stress is going to come in with TRID. It's going to come in for the lender, and ultimately it's going to go down to the consumer if the lenders aren't doing and preparing as they need to for these new timelines. So how do you proceed in the closing process? It really is about three things: communication, realistic expectations, and a sense of urgency. Now, we've always had that. It's important to communicate. It's important to set realistic expectations, and it's important to have urgency. Even more so now with these timelines. If the closing dates are not extended enough to accommodate, it's going to make it just a little bit more stressful during the process. Now, timeline clarification, there's a lot of it going on for clarification for the loan estimate and the closing disclosure. It basically is allowing the clients time to be able to review and make sure that they want to continue to go forward. So the big one really is in the closing disclosure at the end of the process is having 3 days for you to actually review and make sense of this disclosure. 6 days if it's getting U.S. postal mailed through the mail. So you're hoping that your lender has electronic, the ability to send it electronically, so we can actually back that down to a 3-day period to make sure that we can meet the closing timelines. So lots of information about TRID. I just gave you a couple minutes here in the Money Chat because really the show is about the guest that I have in today. If there's more questions that you have, please, again, call the show at 1-855-400-1150. 1-855-400-1150. You can get me if you want to talk to me directly or, again, any of the guests that I have in studio. And coming up next on the Money Hour, neither seniors' parents nor their adult children find this role reversible, comfortable. How do you navigate through it? What do you need to know? And who do you need to have on your team to help the transition with our seniors? Kathy Weidlich, founding of Legacy Caring, right here on 1150 AM KKNW after this short break.